So we're recording. So thank you, everyone. We're very excited to have you here. We only have 13 participants, but I'm sure by the time that the end of the session comes on, we'll have probably 30 or so. So I'd like to welcome Judy Cotte. Judy is the CEO of ESG Global Advisors, a firm that bridges the gap between companies and investors on environmental, social, and governance factors. And she has over 20 years of legal experience, the last 10 of which have been exclusively focused on ESG. And she's a globally recognized expert on ESG and responsible investment. So we're so glad to have you with us today. Prior to joining ESG Global Advisors, we're actually forming ESG Global Advisors, Judy was a VP and head of corporate governance and responsible investment for RBC Global Asset Management. And previously to that, she was the Director of Policy Development and Chief Operating Officer for the Canadian Coalition of Good Governance. She has a master's degree in securities law and practiced law in various capacities, including as enforcement counsel with the OSC, litigation counsel with large broker dealer, and a partner in a Bay Street law firm. So thank you so much for joining us, Judy. We're so thrilled to have you here. Last year was the first year you were here, and so much has changed even over the last year. This is just like booming. So we're excited to hear what you have to say.
Awesome. Well, thank you so much for having me. I actually realized I have to update my bio. It's been almost 13 years on ESG, which someone recently told me that makes me the grandmother of ESG in Canada, which they meant as a compliment, but I'm not quite sure I took it that way. So anyway, thank you for having me. Just a few words. I can't see you all when I'm sharing my screen, so please do feel free to speak up if you have a question, but I will pause throughout for questions. Or you can enter them in the chat and Catherine can speak up and interrupt me, but we should also have some time for questions at the end. So we are going to, why won't my screen move? Oh, I know why. There we go. I have to go back now. I had to put my cursor back in the chat. So we're going to look first at what ESG actually means and how it relates to the broader concept of corporate social responsibility. We're going to look at the extent to which investors are focused on ESG and the reasons for it, a couple of which being the link to corporate performance, as well as the real explosion of regulatory and policy initiatives in this area. We'll also look at the growing focus on ESG by lenders and research and rating agencies. And then we'll look at a few ESG and climate-related disclosure frameworks, which I'm sure many of you are grappling with. So first, what do we actually mean by ESG? There is a lot of overlapping and confusing terminology in this space, and it seems to grow every day. ESG, environmental, social, and governance factors, are those that present risks and opportunities that can have a financially material impact on a company's value. So these are broader strategic factors, not typically considered by portfolio managers because they have to look beyond the financial statements. And one shorthand way of thinking of it is that ESG is focused on value, whereas corporate social responsibility is more focused on values. But that's not perfect. And we created this graphic to illustrate the difference. And if you look at that blue circle, which sets out material financial issues that were historically of interest to shareholders and bondholders and lenders, and then the green circle represents those broader, what I would call CSR issues that were typically of interest to employees or clients or communities, but generally not of interest to investors. And quite honestly, that green circle still represents much of what you see in corporate social responsibility reports today. A lot of it is not financially material and not of much interest to investors. But where those two concepts overlap, and so you're looking at CSR factors that are or may have financial impacts on the company, then you're into the world of ESG. But of course, the border between them is really not perfect. And in fact, I would say it's quite porous because CSR issues tend to become ESG issues when they're not well managed. And when they get to the point where they start to affect a company's brand or its reputation, its license to operate, or result in legal or regulatory challenges. But then what's also happening, and this arrow is supposed to represent, is that more CSR issues are moving into that overlap. So many people believe this is really a lasting secular shift. And it's the growing sense that really companies need to harness and reflect society's changing values in order to continue to deliver profit or value. And that's driven at least in part by climate change, but society and millennials in particular are embracing sustainability priorities in a new way and really making them a priority in the products they buy, in the way they invest, and in the companies they choose to work for. And the prevailing view really is that this is a secular shift. And so to be able to attract investment, to be able to attract top talent, and to be able to get consumers to buy your products, you are going to need to reflect those values. So really the lines between value and values are blurring more than ever. So this slide looks in more detail at what factors typically are financially relevant under each of the categories. We're not going to go through this in detail. And I think the more important point is why I've structured the slide this way, with G at the top and E and S and other financial material issues below. And that's not because they're less important, it's because ultimately accountability for all material issues, whether purely financial or social and environmental, rolls up to the board. And in my experience, they're quite interconnected. So when you see a company that isn't managing its E&S issues well, chances are it's not very well governed, and vice versa. And of course, many E&S issues are really related to each other and interconnected. So climate risks, for example, often can serve to exacerbate other environmental or social risks. And of course, reputation risk cuts across all of these because they can happen to the company directly as a result of its policies on any E&S issues, or indirectly because of the actions of another company found within its supply chain. So how does this play out in the investor universe? You've probably heard a lot about the terms responsible investing, sustainable investing, socially responsible investing. And you know, there's different interpretations of the term, but for North America, certainly, and for most of the world, sustainable investment or responsible investment really are broad umbrella terms that refer to one of the three styles, starting with the middle ESG integration and moving towards the right. And I like to think of it as a bit of a spectrum from on the left of your slide, moving from a pure focus to finance only to more towards the values side as you move towards the right. But it's worth pointing out that no matter what term is being used, sustainable, responsible investment, the vast majority of institutional investors are using an ESG integrated approach, which means that they're still focused on earning a financial return, but paying attention to the risks and opportunities represented by ESG issues. But in an ESG integrated fund, you can own any kind of company, even those that have poor ESG practices, but then there is an expectation on the investor that when they own those companies, they will engage with the companies in which they're invested and use the power of their capital to encourage them to improve their practices. Further on the right, socially responsible investing. So that is also seeking a financial return, but typically uses negative screening to avoid certain controversial sectors. And historically, those were very values-based. So alcohol, tobacco, weapons, adult entertainment, increasingly fossil fuels are screened out in SRI funds. And then furthest along the right would be thematic or impact investing. And those funds are made up of companies whose products or services are in some ways trying to solve some of the world's environmental and social problems. They are typically also seeking a financial return and more a market return, but you will still see some that target a slightly lower return in exchange for the positive impact they are helping to create. So to what extent has responsible investment broadly become mainstream in the market? Well, you can get just a little bit of an idea by looking at the signatories to something called the UNPRI, or the Principles for Responsible Investment. That's entirely voluntary, and signatories commit to follow 6 principles, chief among them being that they will integrate ESG into their investment process, that they will engage with the companies in which they're invested on ESG issues, and they will use their voting rights in support of those issues and seek better ESG disclosure from the companies in which you're invested. And as you can see, there has been a rapid increase in signatories. As of March 2020, there were about 3,040 signatories representing over 100 trillion in assets. Another pretty striking statistic, Morrow Sodali did a global survey of institutional investors representing about 26 trillion in assets. And in 2020, 100% of them said ESG had played a greater role in their investment decision-making over the last year. And this I thought was interesting. It was just released, and part of what I like about it is it was not an ESG focused survey. Sometimes I worry the ESG focused surveys, there's a bit of respondent bias, that the people who care about ESG are the ones responding. This was just a broad institutional investment survey from 200 asset owners across the world, representing about 18 trillion in assets. And as you can see, 73% of them plan to increase their investment in, or their ESG focus by the end of 2021. 79% are regularly using climate data to manage risk, and 64% of them are sometimes or regularly using climate data to identify opportunities. And over on the right, it's a little bit small to see, but as you can see, the largest funds have said that the COVID-19 has in fact accelerated their focus on ESG. And I'm just going to go through a few more stats and then I'll stop first to see if there are any questions if you want to get ready for that. So where has all this growth left us? Well, in the US, which is on the left side of your slide, we now have 1 in every 3 professionally managed dollar using some form of responsible investment survey. And this one actually breaks it down by style. And so as you can see, the blue represents ESG integration. And as I said, that's not surprising that we see that as the largest style. And then over on the right in Canada, you see just over 3 trillion of assets using some form of responsible investment strategy. Again, the vast majority of that would be ESG integration, and so up considerably over the last few years. So maybe I'll stop right there and see if there's any questions before we look at how the market is responding.
Absolutely. So any questions from the floor? You can either unmute yourself, throw something into the chat. I'll just ask a quick one while people are thinking about this. Is there some worry, or are there, I've heard that there's a worry about sort of greenwashing of some of these approaches. You know, we do a little bit of something and that's good enough, and therefore we all call it ESG. I mean, is there kind of a relativeness to this, you know, the maturity within certain organizations, and where is that data?
Yeah, no question. There is huge variability, particularly in ESG integration, which is harder to judge, right? So some asset managers are doing a very thorough, comprehensive job. Some are just getting started. But because of that variability, the regulators are starting to step in. So in Europe, in March of this year, something called the Sustainable Finance Disclosure Regulation has just come into effect. It's going to get more prescriptive from now until the end of June 2022. But investment managers are going to have to disclose exactly how they integrate ESG. But controversially, they're also going to have to disclose how they consider the negative environmental and social impacts of their investments, which is something that was not typically done as part of an ESG integration strategy. So asset managers and owners are scrambling, because that will apply to Canadian asset managers who distribute their funds in Europe. In addition, the SEC just announced they've set up an enforcement task force on ESG and climate. And in addition to looking at corporate disclosures, they're starting to look at the claims being made by investment managers around ESG and responsible investment. So I think you're going to start to see more regulation. And I should mention the CFA Institute has suggested a set of voluntary guidelines. I'm not sure if they're finalized yet, but they're moving towards voluntary guidelines around naming conventions. So what can be called sustainable or responsible. And I think that's all positive, because I think it is very hard for a retail investor to assess exactly what approach is being followed by a manager.
That's excellent. Go ahead. Yes.
Sorry, Judy, it's Marianne O'Leary. Just a question for you. Do you see one framework becoming dominant, or something like IFRS, because it's universally applied, adopting one and promoting? And then on the reporting side, do you see more and more, especially in Canada, disclose or explain legislation coming? And if so, on those, what timelines do you see?
Yeah, so great questions. We are going to look in more detail at the reporting frameworks for corporates. There is a lot of consensus around SASB and TCFD, which we're going to look at in more detail. But I would say exactly that the IFRS indication, so this is the IFRS Board of Trustees, which sets global IFRS accounting standards, have indicated that they are going to set up a sustainability accounting standards board. They're probably going to announce it by COP26 to look at creating global sustainability accounting standards. And they're going to start with climate and move on from there. I think that has the capacity to be an absolute game changer globally. And investors are all urging them, please don't start from scratch. Take the good work done by SASB and TCFD and roll that in and make it a required accounting standard. We have not seen much movement in Canada yet. The recommendations of the Ontario Task Force to modernize securities legislation did recommend that companies be required to disclose on climate under TCFD. Now that was Ontario only, but it likely will be influential. But there's no clear timelines there, because that task force, there's no clear path to making that happen from a regulatory point of view. I mean, it's recommendations made to the Ontario government, many of which would have to be implemented through the securities regulator or potentially even corporate regulators. So unclear what the timeline would be. But we're also going to talk about the fact that the SEC has announced they're reviewing their existing climate guidance and looking at making climate and potentially broader ESG disclosures mandatory. And so I think that, what the SEC does tends to spur the Ontario or Canadian securities regulators into action. So that might have a bit of a catalyzing effect as well.
Excellent. Good. All right. Thank you.
Okay.
Any other questions anybody seeing? All right, maybe we should carry on. Thank you.
So just in terms of how the market is responding, in terms of fund flows, we'll move through this pretty quickly, but this just shows that as at the end of Q3 2020, There were $80 billion of net inflows into funds that are some way marketed as sustainable or responsible. Again, the majority of which would be ESG integration. And as we can see, Europe, which is blue, accounts for the vast majority of that, and the US is much smaller. However, when you unpack the US and you look at the stats, you can see that the growth, so this chart is US only, and you can see that the flows into those funds really is quite exponential. And then, of course, what happens is the investment industry responds. So this is the launch of funds that are some way marked sustainable or responsible. And as you can see, this has also been growing quite exponentially. This is US data. And then this gives a snapshot in the US of the number of funds that currently exist. The other one was launches. We just look back for a second. This was launches throughout the year of funds marked sustainable or responsible. And then this is the current state of funds in the market marked sustainable or responsible. And again, it is this proliferation of funds with vague naming that is spurring some of the regulation that we talked about in response to Catherine's question. So of course, within this broad focus on ESG, there's a significant focus on climate. And part of that is because climate change really does represent a systemic risk, and you can't really diversify away from it. As you may know, Larry Fink, the CEO of BlackRock, the largest asset manager in the world, writes a letter to CEOs every year. And in the last few years, it's been very focused on ESG, with the last 2 years being particularly focused on climate. And it is important to, and one thing that really got a lot of attention that may be interest to many of you is that in this year's 2021 letter, he said not only do they believe companies should be considering climate, but they are looking at companies, they want companies to disclose how their business model is compatible with a net zero economy. And they want those plans disclosed and disclosure of how that plan is incorporated into their corporate strategy and how the board of directors is overseeing that plan. So that is a really significant ask. And, you know, I always joke there's about 9 trillion reasons why people pay attention to Larry Fink's letter, and that's about the size of their assets under management right now. And it's important to note that climate risk is not just about carbon. I mean, people are very focused on carbon, and SASB, which we're going to talk about, the Sustainable Accounting Standards Board, has found that climate is material for 72 out of 77 of their sectors, but carbon is only material for 23. So it is important to keep in mind that climate does represent broader risks that can have significant economic impacts. And when you look at these two surveys of institutional investors, you can see that they really agree with Larry's comment that climate risk is investment risk. So you see in 2019, a very large survey of institutional investors, 93% of them believe that climate is not being properly priced into financial markets. And similar findings in the other survey, which was even larger, finding that climate is not being correctly priced into company or sector valuations. So, and one of the main reasons that investors have become so focused on ESG and are pushing companies so hard, I mean, climate is one of them, but broadly speaking, there is a lot of academic research showing that companies that manage their ESG issues well perform better. And so this is just highlighting two meta studies and then one interesting study. So the one on the left of your slide looked at 2,000 underlying academic studies. The one in the middle looked at every single academic study they could find. It was about 2,250 to look at that connection between ESG and performance. And the vast majority of those underlying studies found that companies that managed these issues well had lower risk, lower cost of capital, better operational performance over a wide variety of measures, and better share price performance over the long term. So I can tell you that really holds a lot of weight with institutional investment managers who are always looking at different ways to understand a company's potential performance. And then I also wanted to highlight the paper on the right, done by a professor at Harvard who's done a lot of writing in this area, because it's so interesting. Using the SASB standards, which were quite early at that time, it was 2015, he found that indeed companies with good performance on financially material ESG issues did indeed outperform, but companies with strong performance on immaterial issues did not outperform. And the very best performers were companies that performed well on material issues and perform poorly on immaterial issues. And so to me, that suggests there's a bit of an efficiency argument here, because of course, companies can't spend time and resources on every potential ESG issue that might be relevant for them. They really need to hone on the ones that might actually represent a financial risk or indeed a business opportunity. So it always reminds me of that famous quote attributed to Einstein, that not everything that counts can be counted, and not everything that can be counted counts. And I think that's particularly apt in this context. So just to put a final pin on the performance piece, this is a recent survey from my former firm showing the extent to which investors are confident about the relationship to performance. And you can see that the vast majority of them believe that an ESG integrated portfolio will perform as well or better than those that do not integrate ESG. But probably most interestingly is the majority, at least in Canada, Europe, and Asia, believe that integrating ESG will actually help them generate alpha, so outperform the market. And I think part of the reason for that is because ESG issues are quite qualitative and really do need some nuanced judgment to understand and assess. It's not, doesn't really lend itself to a numerical score, which we're going to talk more about in a moment. So asset managers or asset owners that really understand these issues well and can apply their nuanced judgment may be able to see what the rest of the market doesn't necessarily see. The second thing that is definitely fueling investor attention is the veritable explosion of regulatory and policy initiatives in this area. We've talked about a couple of them already, and we'll talk about a few more. But this chart I thought was useful, and in fact, the PRI has just updated it, and you see an even greater uptick at the end of 2020. But this looks at the rise of ESG-related policy instruments across the world's 50 largest economies. And as you can see, the growth is really quite exponential. And what's quite interesting is that 80% of those measures are really, they're targeting institutional investors rather than companies. And so many companies at first find that comforting, but in fact, they shouldn't take comfort, because what happens is when these requirements for better integration or disclosure are foisted on investors, the only way they can satisfy those requirements is to turn to the companies in which they're invested and pressure them to provide them with better information. And in fact, many regulators will admit that they are using the ecosystem in that way. Like, they realize that shareholders have the power of their capital, and they're probably going to be more effective at driving change than just non-prescriptive regulation. Now, it is worth noting on the non-prescriptive point that even if regulations are voluntary, they may become de facto mandatory. And the PRI is a great example of that. Even though it is voluntary for investors to sign, I can tell you that asset managers view it effectively as mandatory, because they're just not going to get business from large asset owners in most markets if they are not a PRI signatory. And of course, since capital is global, regulations elsewhere often shape the expectations of investors in the companies in which they're investing, irrespective of whether it is the law. Like, sometimes companies will say to me, well, that's not the law. I don't have to provide that disclosure. Why would I do that? Well, the reason is that your global investors have come to expect it as a result of the disclosure they see in either their home market or other markets. And if you don't provide it, since capital is global, there's a risk that they'll simply go elsewhere. And just to highlight, I'm not going to go through this in a lot of detail, but just to highlight some of the regulatory action we're seeing in Canada. Of course, we saw the recommendations of the expert panel on sustainable finance, a federal panel struck by the Liberal government, and it issued a variety of recommendations to mobilize capital towards more sustainable alternatives, and it did recommend phased-in mandatory TCFD disclosure. We talked about the Capital Markets Modernization Task Force. Again, Ontario only, no clear path to making it law. But in addition to their recommendations for mandatory TCFD reporting, they put out a variety of quite broad ESG related recommendations, including mandatory diversity targets for the board and executive management. They represent that to be 50% women, 30% BIPOC, people with disabilities, and LGBTQ+. They recommend term limits for directors, which would be 12 years or 15 for the chair, mandatory review by companies of proxy advisor recommendations. So it remains to be seen what will happen with that, but I suspect it will certainly have some influence in shaping certainly the Ontario market and likely other markets as well. OSFI in January of this year issued a consultation on climate risk. It was very focused, obviously, on the financial sector that it regulates and looking to engage with its regulated financial institutions and pension plans to understand how they are identifying, measuring, and building resilience to climate risks. And they have said clearly that the consultation is going to guide future regulatory and supervisory approaches by OSFI. So it's a bit of a hint that there's something coming in that regard. OSFI and the Bank of Canada also announced a pilot project with numerous of the largest financial institutions to really build on and understand the capability of those institutions to conduct climate scenario analysis and really support them in honing the data and the methodology in order to do that effectively. Maybe before we go into the US, maybe I'll stop there again for a minute to see if there's any questions or comments.
Great. I do see one here from Pierre, and this burgeoning field. His question has to do about talent, and we have people graduating from this program, but all people. Talk to me a little bit about how people are making the transition, how what the sector is looking for in terms of kind of bringing in people that understand sustainability, ESG, social environmental issues. Do you have a sense?
Yeah, it's
that?
A great question, and of course, to the grandmother point I made earlier, for a long time there was no formal education unless you were in a pure environmental science program. So I actually think it's hugely positive that universities are stepping up and there are more and more sustainability focused programs and courses, and I think that is much, much needed. On the investor side, the CFA Institute in the UK had developed quite a comprehensive certification program for analysts and portfolio managers, and they've just brought that to Canada. So that will really help on the investor side. So I think there's a lot of talent at the junior levels because it's people who are coming through these programs. At the senior levels, it's a little bit more of a stretch, but what you tend to see more is people like me who started out in a different area, whether it was law, risk, accounting, who have had experience working with these issues either on the investor side or on the corporate side, and are now kind of pivoting and focusing more completely on it. But I think it's a huge challenge, and I think it's a bigger challenge at the corporate level in many ways, but it's a great area to be in. That's the good news, is there's lots of demand for talent and people with some actual formal education in the area.
Excellent, great. Other questions for Judy at this time? And while you're thinking about those, I have a bit of one for you, Judy.
Yeah.
You know, from the very beginning, you've talked about how kind of the non-material issues and kind of those soft CSR, kind of almost the social issues to some degree, given the fact that those issues are harder to measure from an impact, you know, like climate change, we can put numbers on it. We can talk about carbon and we can talk about water level rising and things like this. Will those things always trail or be considered less financially material? You know, because I know how there's been a big explosion of, you know, focus on diversity and inclusion since last spring. And I'm just wondering how the measurement of that is coming along, and is this kind of a fad that will fall off?
Yeah, it's a great question. And, you know, it is really hard to measure. And I think there's probably no perfect answer. But I will say, even before the growing focus on, you know, kind of treatment of frontline workers and diversity, you know, there are strong correlations between employee engagement and turnover and productivity. That's something portfolio managers have measured in quite a granular way for some time. And you can put some numbers around that. You know, there's a science around measuring employee engagement, and you can certainly measure turnover and productivity, you know, profits per employee, et cetera. And so I think it's more, there's a growing understanding that diversity, that respect for workers at all levels of the organization is really an important input into that engagement piece, which then leads to some productivity measures. But I think it's always going to be difficult to measure, particularly around culture. Like, culture is so difficult to measure. And I know there's work going on about, you know, how could you measure it? How can the board oversee it? That's a really tricky one, given how removed the board is from the day-to-day operations. But I don't think it's going to go away. I think it's only going to be amplified as people realize more and more that this is an important input to engagement. And quite frankly, the demographic research suggests that millennials care more about this than any other demographic. And by 2025, they're going to be 75% of the workforce. And they really only want to work for companies more and more who they see as having values that are aligned with their own. So companies are realizing this is going to be critical in the war for talent. So they're only going to have to step up and start to set, you know, one way you can measure it, of course, is through diversity targets. I mean, it's a place to start. That doesn't go to the culture piece, but I think it's an important first step in making an organization more inclusive and building a better culture.
Yeah, we talk about living wages and a bunch of other things too.
Yeah,
Judy.
Just connected. Well, I was going to ask Sassy's question first, Marianne, because it's related to what Judy was just talking about. She's asking, would you think that the increased attention on ESG will actually diminish the focus on CSR?
I don't, because I think they're two reasons. They are so interrelated. So, you know, what is a broad, nice to have CSR issue today can with one tweet become an ESG issue, right? So I actually think it's increasing the focus on it. I also think that as this value shift that I talked about, that I tried to represent with my arrow, as society cares more and more about the values of an organization and those broader CSR issues, I think more and more of them are going to become financially material, so that the overlap circle in our graphic is going to grow bigger and bigger. It's like the chair of BP said in an interview within the last 6 months, you can't have long-term profit if nobody wants what you're selling. And that's just kind of a stark example of how they are related. Society wants more low carbon energy. And if you're not moving in that direction, you're not going to have a product to sell over time. So I think it's going to amplify the importance of it because of that interrelationship and the fact that more of those issues are being understood as financially material.
Terrific, thank you. And then Mary Ann, and then we'll move on. So Mary Ann, did you want to ask your question?
Yeah, when you think of ESG, as you mentioned, the governance is sort of the umbrella, because without it, the other things just don't happen. But if you took it as a pie and you divided it and you use that as a formula for where the investors care more on the weighting and where the company should allocate resources, how would you divide the pie?
Well, I think, it depends a little bit on, like, you mean dividing the pie between ESG and CSR, or
Nope.
Between ESG issues themselves?
Between the E, the S, and the G.
Oh, I see, between the E, the S, and the G. Yeah, so I would say the G always has to have kind of a dominant piece of the pie. And then the E and the S, and which issues within the E and the S, very much depends on your sector. And I'm a big fan of companies, kind of as they start on this journey, either wanting to do things for the first time or do them better, doing a very focused materiality assessment so that they can decide for themselves which E and S issues really are material for their business, and then divide the pie that way. So I think you always have to have a third on governance, call it, and then maybe there's room to play within the E and the S. But I think it's very company and very sector specific. So companies have to do that initial assessment to understand what's material and where they should focus their resources, which is what that Harvard study I highlighted was really getting at.
Super, thanks so much.
So I'm going to do just a quick sort of rapid round of highlights of what's happening in the US, because it has been truly explosive. So as we know, the Biden administration immediately rejoined the Paris Agreement, put what he said is the US on the path, irreversible path to net zero by 2050. He has established several new agencies focused on climate change, which he has said has the broad aim of elevating climate change to a national security and foreign policy issue, which is obviously quite a dramatic change from the previous administration. He's made several appointments, of course, John Kerry as Special Envoy for Climate, which gives him a seat at the National Security Council, which is the first time there's a climate representative on the National Security Council. Many people found it quite interesting that his appointment of the director of the National Economic Council is the former head of sustainability for BlackRock. Many people think that's a pretty powerful signal. Janet Yellen has pledged to create a team within the Treasury focused on climate change, and also an interagency working group to assess the social cost of carbon, which many people think could in fact be a prelude to some form of carbon tax. And then, as we mentioned earlier, the SEC has been particularly active, and just on March 15th, in a speech, the acting chair has said that ESG and climate are now front and center for the SEC, and there's no issue that has a greater priority. They've created a senior policy advisor on climate and ESG for the first time. And as mentioned, they've created this task force to identify ESG related misconduct, which is both on the corporate side in terms of corporate disclosure, and then also on the naming / greenwashing side of the investor. And they've issued a formal consultation as to whether they should be issuing more mandatory rules for climate disclosure. So that's currently open and open for 90 days. It's not a rulemaking initiative, it's a request for information, but the questions are largely focused on climate. And yeah, so the chair has made it quite, she's tipped her hand in a variety of speeches that she seems to believe that climate certainly, and perhaps ESG disclosures need to be more mandatory. And I was just speaking to a senior policy person in the US because she's just the acting chair and there's a new chair coming in. And I wondered if that was going to suggest there's any kind of change. And she said, no, the new chair, the new permanent chair is expected to just take on all of these statements and run with them. So of course, this is not just an equity market issue. ESG is making its way into credit ratings and lending. So all the big credit rating agencies now have integrated ESG into their core credit ratings in a more transparent way. Moody's just released its new ESG issuer profile scores and ESG credit impact scores, which is their effort to make their analysis more transparent. It's interesting, in April of last year, Moody's published a report where they said that ESG considerations were a material credit consideration in more than 33% of their rating actions for private sector issuers. 85% of them related to governance, 20% to social, and 16% to environmental. But the bigger issue, and I was actually quite surprised, they said that really ESG issues were key drivers of the rating action in those actions. So of course, there's also been a proliferation of commitments by the big banks around sustainable finance. Now, sustainable finance, I would say, is probably one of the most poorly defined terms in this area. The expert panel report does contain a very broad definition, but I think it's fair to say from the bank's perspective, sustainable finance is very focused on financing products with some kind of green connection. And it's also being integrated into their risk assessment for project finance and general corporate lending. Now, Goldman Sachs had really stood out on this slide at their commitment at $750 billion, but just about a week or two ago, you had, or maybe a couple of weeks, you had RBC increase their commitment from 100 billion to 500 billion. And then just a week or so ago, BMO updated its goal to be 300 billion in sustainable lending by 2025 and 700 billion in responsible advisory and investment management mandates by 2025. And of course, BMO also announced the creation of what they're calling the BMO Climate Institute to work with their clients on mobilizing finance towards lower carbon solutions. So of course, what do we mean by green products in lending? So we're talking about green bonds, or for Canada, transition bonds. And a transition bond is meant to get at industries like oil and gas that would never qualify for a green bond, but if they wanted to raise money for a project that was helping to lower their carbon footprint in some way, that they could qualify for a transition bond. But probably the more interesting thing where you're seeing loads of activity globally is in ESG or sustainability linked bonds or loans. What issuers like a lot about them is they can be raised for general corporate purposes, not project finance, like a green bond or a transition bond. And they can be linked more broadly to ESG goals. So one example would be Royal Dutch Shell issued obtained a $10 billion revolving credit facility, the interest rate of which was linked to its ability to meet its carbon reduction targets. You might have seen that Enbridge, the first Canadian energy company to issue a 3-year sustainability-linked loan, and its interest rate was tied to its ability to meet a variety of ESG-related targets, including 40% of women on the board, 28% racially and ethnically diverse workforce by 2025, and reducing their emissions intensity by 35% by 2030. Goldman has in fact recently announced that ESG-linked loans are now core to their whole strategy for sustainable finance moving forward. So I think we're going to see a lot more activity in this space because companies like the flexibility it gives them over green bonds or transition bonds. So I'm going to talk quickly about ESG research and ratings providers. If you work for a company, it's probably the subject you love to hate the most. There's obviously been significant growth in the number and type of companies providing ESG-focused research on companies. Most of them create a score or a rating under each of E, S, and G, and then aggregate it up to an overall ESG score, usually accompanied by a pretty in-depth report of, call it 50 to 75 pages. In North America, fair to say that Sustainalytics and MSCI are the market leaders. Now, how is it being researched? How is it being used by investors? That's an important point because more and more, as investors get more thoughtful on their approach to ESG integration, I think it's fair to say that they are relying less and less on these reports. And they are an input that they consider, but I think most thoughtful investors are not simply relying on the score, although we'll talk a little bit about indexes in a second. I think it's worth pointing out that while these have historically been focused on public companies, there's been growth in coverage of private markets. So the firm Apex, which provides financial and advisory services to investors, has now rolled out an ESG research and rating system for private companies. And ISS ESG has just announced they're going to start comprehensively covering private companies. And it's worth mentioning the new type of research provider, which I would include, the leader of that would be True Value Labs, which was just bought by S&P, as well as Arabesque S-Ray. And what they do is, well, I'll focus on True Value Labs because I know the product the best. It doesn't look at corporate disclosure at all. Instead, it trolls the internet for evidence of what the company is actually doing or what people are saying about the company. And it uses an AI-based system to learn. Many of its indicators are updated daily and many in real time, which is one of the criticisms of the traditional ESG research providers because their reports are only updated once or twice a year. And True Value Labs also allows investors to apply the SASB materiality lens over it to try and get rid of some of the noise you would inevitably see. And so that's relevant because, of course, it's very easy to pick a private company and just have it added to the search lens of these different types of providers. So at least in the ESG research space, I think it's fair to say that the lines between public and private are starting to blur a little bit. So one of the reasons everybody is often so annoyed with the ESG research providers is because their ratings are often very different from each other. So just if you look at this image from a study done by the Wall Street Journal, which looked at 3 of the 5 largest companies and the ratings done by 3 leaders, Sustainalytics, FTSE, and MSCI, you can see that there is widespread divergence, right? If you look at Tesla, FTSE puts it at the bottom of the barrel on the environment, MSCI puts it at the top. There's a lot of dispersion. And in fact, a big study we did when I was at RBC showed that in fact, across 5 large providers, they only correlated roughly 50% of the time, which is no correlation at all. But I think that's less and less of a problem as investors are getting more thoughtful about how they're using this research. And I think there's a broad understanding that these ratings, first of all, as I said earlier, many ESG issues are qualitative and don't lend themselves to a numerical rating. And the reports, they contain fact, but they also contain a lot of subjective opinion. So I think investors have started to look at them more the way you would a sell side report, you know, a buy, hold, or sell recommendation. I mean, there's no good investor that's blindly following that. And I think that's where the ESG research providers are moving. And it's quite interesting when I mentioned the sell side, you are seeing more and more. The sell side is integrating ESG into their core research of companies, which I actually think is quite positive because they are considering ESG issues along with all the core financial, operational, and strategic issues they consider for the company. The one area where companies have lingering concern that I think is quite legitimate is how ESG relates to passive investing. So as you probably know, there's a massive shift towards passive investing because it's cheaper and many people believe active managers don't beat the market. And as we saw earlier, massive shift towards ESG investing. So as those two trends collide, you're starting to see a proliferation of ESG indices. Now, the only way to do ESG in a passive vehicle is by creating an ESG index, which almost always uses scores or some combination of scores, and you either exclude a company that doesn't score well enough, or you underweight it within the index. And so that has some companies quite concerned about the cost of capital implications. My light just went out, that's why it looks dark, because it's movement generated. So that has companies concerned about the cost of capital implications if they are excluded or underweighted within ESG indices simply because of their score. So looking quickly, we're getting close to time. I see just looking quickly at some of the key reporting frameworks on the corporate side. As I mentioned earlier, there's no question that SASB and TCFD are the investor favored frameworks. The GRI is still the most widely used, but the key difference between them really is that SASB is using the US securities law definition of materiality when it makes its decision about what is material. So essentially the same as the definition in Canada, which is, would it affect a reasonable investor's decision to buy, hold, or sell? GRI is a much broader definition of materiality, which essentially says, is it sufficiently important for the company to be reporting on it? And another difference is that SASB is another way to put it rather, is that SASB is very focused on how changes in the world might impact the company, whereas GRI is more concerned about how the company's actions might impact the world. So SASB is more inward looking, GRI is more outward looking. And so you can see why investors tend to favor SASB because they're focused on the financial evaluation of a company. And then as we mentioned earlier, I do think the IFRS movement towards creating global standards will be quite a game changer. TCFD, you're all probably broadly familiar with it. Support as of February of last year, it was over 1,200 organizations representing a market cap of over 12 trillion. I think it's fair to say it is the global standard for reporting of climate-related risk and opportunity. One thing many companies fail to notice is that the governance and risk management categories are meant to apply to all companies, irrespective of whether climate is material for you. And then the strategy and the metrics and targets are only meant to apply if climate is a material risk for you. And just looking quickly at the support for it, at least in Canada, as we've talked about, the expert panel, the task force have recommended that it be mandatory. CCGG has endorsed it. 8 of the largest pension funds in Canada came out with a joint letter for the first time endorsing TCFD as well as SASB. The federal government has made any recipients of the large employer emergency financing facility put out post-COVID to report in line with the TCFD. Of course, UK and New Zealand have made it mandatory. So there's all sorts of signals that we are heading towards at least mandatory TCFD disclosure. Similarly, in the US, all the largest investors have endorsed it. And then, as we've already talked about, the SEC has formally opened up their climate-related guidance and hinted that they may make it mandatory. And also the Federal Reserve Governor, in a variety of speeches, has hinted that voluntary disclosure may no longer be enough, and we may need to make ESG and climate disclosure mandatory. So I'm going to stop it there, just on the nose, but I certainly have time for questions, if anybody has any more they would like to ask.
That's terrific. So yes, let's take some more questions. If you have to drop off, I am continuing to record, so you'll be able to listen to those. And thank you, Judy, for sticking around for a few minutes. Marianne, did you have a question?
Yeah, I do actually. If you ignore mining and petroleum, because they were ahead on a lot of this, simply because they needed a social license to operate, if for no other reason.
Yep.
And you think about a new issuance of bonds, whether they be traditional or a green bond. TD has said that they can only see 2 basis points differential because the take-up rate for so many companies is still so high. There's a lot of capital chasing too few product or too few this.
Mm-hmm.
What indicators do you think will show a divergence on that?
Like, as in what will cause it to actually get a more meaningful spread?
Yes, exactly.
Yeah, I mean, it's a great question, and that is the source of a lot of skepticism around, you know, sustainability linked loans or green bonds or transition bonds. I think, I don't know, but I suspect the more products there are, and the less you have these wild oversubscriptions, right? Like the more choice investors have, I would think you may start to see a more meaningful spread. I quite like the idea of the sustainability linked loans because they're, you know, it's the company saying, look, you know, I want to, you know, set and meet these targets. And what's starting to happen there, to your point, initially you would only get a fee break if you met them, but you wouldn't be penalized. But now increasingly they're going both ways. So you'll get a break if you meet them, but then you'll actually pay more if you don't. So I was just reading that recently, that some of them are starting to have that feature, which is, I think, positive, right? Because it creates even more of an incentive. So I don't really know the answer, but I suspect as there's more choice and you're not getting, you know, all the money chasing the same deals, I would hope that will widen. It will become a more meaningful incentive.
Great.
But it is an issue currently, for sure.
Great question. Judy, I have one that Julie put something in the chat earlier about, you know, it's great that there's these trends in the US and Europe and whatnot, but she'd love to see things happen in Canada faster. But what's the advantage of companies moving now, given the fact, you know, and let's say you're a pension fund or just an organization, of moving now versus waiting for, you know, all of these requirements to come into place?
Yeah, so I would say, so first of all, if you're a corporate, let's start with the corporate first. I think there's no question you're probably getting a lot of, if not pressure, questions from your investors. And it takes time to do it well, like to identify your material ESG factors, to weave them into corporate strategy, to start to collect the data that you need, to maybe set some targets to improve your performance, to start disclosing better to investors, like that can be a really long journey. And so I think from the corporate side, you do not want to do that in response to a regulation that catches you off guard, or even, shareholders are filing more and more proposals on ESG issues. So you don't want to be forced to do it in a hurry because a shareholder has filed a proposal asking for it. So that would be the reason on the corporate side. And it's kind of similar, I would say, on the asset owner side. So if you're an asset manager, you're probably being pressed by your asset owners. But in terms of the asset owners moving, I mean, even if it's not required, I mean, they have could be 75 to 100-year liability horizon. These risks are going to impact their performance. And again, it takes time to thoughtfully integrate ESG into your investment process, whether you're managing it internally or subbing it out to external managers. It really takes time to understand how climate risk might impact your portfolio over that kind of long time horizon. So again, I just think that, it's going to take time. It's a real risk for the asset owners. And so, you might as well get started now before you're required to. The other thing I would say is that Canada, I think, has quite a good history at a lot of ESG related changes happening, I'll call it voluntarily, although they were kind of pushed by investors. So Say on Pay is a great example. Say on Pay started because shareholders filed proposals asking for it. Then the 12 largest or 14 largest companies got together and agreed to do it. And then it got momentum after that. And one advantage of doing it that way is you get to craft an approach that you're comfortable with, that works for you. I think sometimes if you leave it to the regulators, there's a little bit of a risk that they'll get it wrong. So for example, investors really support SASB and TCFD. And so the more companies adopt that and do that, and there's, consensus around it, the more likely it is that if regulators step in, that's what they'll make mandatory. As opposed to if you just waited, they might impose, some other standard that you're not comfortable with or that you don't think adds value. So I think that's probably another reason for the market to move on its own.
Excellent. Other questions from the floor? Anybody have something they want to bring forward?
I do have one other, Judy. So you didn't speak much about third-party auditors. So we're seeing the auditors come in to do energy audits predominantly. My question is, where do you see investor groups asking for more of that third-party verification? And in sort of what order do you see it coming in based on an ability to actually audit?
It's a great question. And, I would say that currently the third-party audit of ESG data, so, the hard data that you might have in an ESG or a sustainability report, I would say it's currently a best practice, but not being demanded. I think that's fair to say. Obviously, there's some investors who are different, but I think it's a best practice. When the Big Four came out together with the World Economic Forum about a year ago with a new recommended ESG framework, which kind of drew on SASB, GRI, TCFD. And so it was the Big Four and the World Economic Forum. I think it was sponsored by Bank of America. And I think that got a lot of skepticism because people thought, they're just giving us something new that conforms to a standard that they're prepared to audit. And, companies and investors had already had so much consensus around SASB and TCFD that really didn't take off. However, again, to the point about IFRS being a game changer, because they are an accounting standards setting body, I would think they will probably be able to move the needle the most. And again, everybody does hope they don't start from scratch, because of course SASB was done like by accountants for accountants. Like it identifies call it 3 to 5 most material ESG issues for each sector, and then recommends a set of accounting metrics for the disclosure of it. So, I think I'm hoping they take that as a starting point. But I think if we get to the point where you have uniformity under the umbrella of the IFRS, you're going to see more and more requests for it to be audited, because at least there will be kind of global standards and uniformity, and it will just be easier to do. So I think once that happens, probably demands for that will accelerate. It's a great question, though.
Terrific. Okay. I think we could stay here all afternoon, but we
Yeah,
won't hold you
probably.
up much longer, Judy. This was a fantastic presentation, and you know, it learned even more than last year, because more is going on. So
yeah, it's fast changing. Yeah,
it is just fantastic. So thank you so much for spending time with us today. We really appreciate that, and thank you very much for all of you that stayed on the call to listen to these questions. And I'll have the recording posted in the next little while. Thanks so much, everybody.
Thanks for having me.
Okay,
Bye.
thank you. Bye.